CEO Yusuf Omari. They just released their numbers, and of course, good news to shareholders as well. But what do the numbers speak, especially on their strategic focus and the likes? So many things as well happening right here, from the tender issue to some exits here and there. So we shall be covering all that. Welcome to the Trading Realm. Yusuf Omari, it's good to see you, sir.
Thank you. Very good to see you, mine as well.
And
it's been quite some time.
It's been some time, yes. But it's always a pleasure.
Yeah.
Let's get straight into it first, because I saw the other day on the dailies you were right there, painted, and something happening about Absa, the acquisitions and all that. Would you paint a picture of what was really happening, especially for shareholders who probably were still keen to understand that, and what are the results like?
Yeah.
I
think the confidence that we've seen coming from Absa Group.
Yes.
In this market, of course, in Absa Bank Kenya, looking at our strategy and the performance we've been having in the past, looking at the vibrancy of the banking industry in Kenya, and holistically also as a country, Absa has had a bigger appetite.
Yeah.
If you look at our strategy, it's anchored on 4 pillars. And one of those pillars is about diversification.
Yeah.
And so diversification means, from an Absa Group, not relying in one specific market.
Okay.
At the moment, the South Africa business delivers about 70% of the revenue or even the headline earnings performance. So it means 30% comes from the other 12 countries where we have a presence. And so diversification then means you want to remove reliance only in one area. And so one of the strategy for Absa Group is get into new markets where you exist in, like Kenya, for example. If legally, it's allowable, then increase your shareholding. And so it follows in Kenya, shareholding from an Absa Group is about 68.5.
Okay.
And so there's an opportunity legally to increase it all the way to 85%.
Okay.
And so that was a desire.
Okay.
So when we look at, the tender offer, a very healthy premium that was given to minority shareholders, about 20%. And for the month, we, of course, as a shareholder, you had to make a call.
Yeah.
And your call is individual. It is a personal call that you're making.
Yeah.
And the way you do that is to say, do I also have a similar confidence in the stock? And if I am going to sell, where am I going to invest?
You're right.
And so it follows, when we look at the results, the shareholding now has increased by about 3.5, so from 68.5 to about 72%.
Yeah.
It tells you that majority of the minority shareholders also have confidence in this stock.
Yeah.
Which is a good story.
It's a good story.
So when I look at it, we are excited. A group has expressed an interest to increase shareholding. Minority shareholders have also put an interest to hold more. They have a confidence in it.
Yeah.
And it's not a shock when you look at the capital appreciation, the dividend yields that has been there in the past, that they have also the desire to hold on the stock.
Okay. And maybe just to speak to, and I love the fact that you've said, it speaks to the confidence the investors and the shareholders here feel about it, and that's why they decided to have the holding position. But is there any expected changes in terms of investments, in terms of products, or anything that you expect to see in regional look from all this, or is it too early to ask that question?
I think from a group perspective, the desire has already been expressed.
Okay.
Our group CEO Kenny has made it very clear that we will be looking at newer markets, both geographically and then in existing businesses. If the opportunities for M&A, if the opportunities like now what happened with the tender offer to increase shareholding, group has already expressed itself. So that desire will still continue. And as we're speaking, I know there's quite a number of discussions that are happening in different markets. If you look at, for example, Absa Uganda, there was an acquisition of the book of one of our competitors. And it just tells you that appetite. And we've seen something similar in Mauritius.
Yeah.
And so expect that from an Absa group to continue.
Okay. Now, you just released your half-year results. Definitely, we have to look at that. But before we get into the numbers first, I want to start with the good news first, because from where I come from, you can see my badge is the exchange. So we are very excited.
Yeah.
Let's speak to the shareholders. This is record, and we appreciate it. And I just wanted to hear, in terms of dividend policy, what led to these decisions?
Yeah.
Yeah.
We've always have a dividend policy of paying out 55% of our profit after tax.
Yeah.
And that is more on a guidance perspective.
Yeah.
Of course, what we normally do when we are declaring dividend, we do a lot of stress testing. We look at, extremes of the macros.
Yeah.
Extremes of your profitability, extremes of the growth in your assets, your risk-weighted assets.
Yeah.
And so through that, we can be able to make a call, whether it's a 55% payout ratio, it could be more, it could be lower, because ultimately you keep capital to be able to grow the business.
Yeah.
So when we look at our capital ratios, they are very healthy. If you look at our Tier 1 capital ratio, it's about 18%.
Yeah.
Total capital is about 20%. So very healthy.
Okay.
Relative to the regulatory limits and even our own internal limits.
Okay.
And then we look at the performance of the business over the period. And so it becomes very affordable for us to then be able to, increase our dividend payout.
Okay.
So for this half one, you will see we've increased dividend payout by about 150%. And if you're a shareholder, Maina, you should be a very excited man now.
Absolutely. In fact, the final question on that is, because a shareholder asked me to ask you, do we expect, the interim dividend to continue on with that, remain consistent at the end?
No, it's a very good question. And it's another good criteria you use.
Yes.
You want to be from a perspective of affordability.
Yeah.
And put in a benchmark on how much you pay going forward. You don't want to see that spiral over the period.
Yeah.
So if you look at, for example, our interim dividend, it's been consistent at 0.2.
Yeah.
Our dividend payout ratio has ensured, as long as your profit is peaking, if you look at the graph that we shared during the results announcement, our dividend has been increasing every year.
You're right.
I think the only year you can, of course, ring fence is during COVID.
During COVID time.
But consistently, you've seen that picking up.
Okay.
So the element of consistency, affordability is another criteria that we use. And so if you're a shareholder, looking at that track record, you can expect that to continue.
All right. Okay, my general question. What do you feel about your numbers this half year when you look at them before we dig deeper into them?
Yeah. I think, Maina, to be honest, I look at it from four-point perspective.
Yeah.
I think resilience for me is one.
Okay.
And resilience, I'm looking at rates came down by about 150 basis points.
Yes.
If you look at our average lending yields. And so we've extended that benefit. We've repriced our book.
Okay.
If you're a customer, you have a facility with the bank, with the bank, you know for sure your rates have come down. So it's more affordable to you.
It's good.
If you're struggling, we've seen now recoveries, and you see later on when we discuss about the details of the P&L, the NPL ratios have significantly improved as well.
Yeah.
And so with that benefit to the customers, we see consistency as we progress into the second half.
Yeah.
So it's at a point in time that you've seen our revenue coming down.
Okay.
So resilience for me, it's one, even with that drop in rates. I think for me, the second one is reducing reliance on the balance sheet.
Yeah.
Reducing reliance on net interest income. So you'll see that our new businesses, all our subsidiaries, doing over 20% growth.
Okay.
So you look at our bank assurance business, asset management, securities and custody business. They've grown by more than 20%.
Wow.
And that gives us confidence because that is sustainable and is not putting that burden of just pegging your financials on the balance sheet. So a good story as well. And if you look at our NFI, you exclude FX and the trading income. We know the margins have shrunk there. our non-funded income has actually picked up by about 9%.
Okay.
So that's the second one. I think for me, the third one really is the balance sheet momentum. Q1, for example, our loans were down 1%. This is Q2, our loans are 8% up.
Okay.
Deposit is 5% up, but within that deposit, the makeup of our deposit has significantly changed.
Yes.
Now 75% is transactional. And the transactional component of our deposit has picked up by about 18%.
Okay.
So I'm looking at the fundamentals, not the P&L, not the quarter on quarter.
Yeah.
The fundamentals is what is important for me.
Okay.
And so that momentum is evident. And then the last one, which is already we've spoken to.
Yes.
The shareholder is a happy man.
Yes.
Dividend
absolutely.
has picked up. The capital appreciation, 37%.
Yeah. On the share, absolutely.
And the shareholder, of course, is happy. Yeah.
I love
that. I think I will sum up our results. It's been resilient.
Yeah.
I see momentum.
Yeah.
And I'm really looking forward to the second half. Because now also, when we start comparing the metrics, the macros that were there last year, we'll be comparing like for like.
I'd like you to paint a picture for us a little bit on the strategic focus, because you are sitting here to ensure that you're still in line with your strategy and your cycle, you keenly follow through on that. But also, allow me to pencil through some of the numbers you've given me, because you said revenues are down, but profit before tax as well. We saw a 16% down, but yet customer assets have grown, as you have said again. So it's an interesting mix when I look at it. And also, asset quality remains still strong. So my ask for you is this: when does that balance sheet growth begin translating back into that earnings growth? If you may paint that picture.
Yeah, we should be able to see that in the second half.
Lovely.
You should be able to see that. And the simple reason to that is when you compare year on year, the macros last year and the macros first half of last year and the macros this period are different. And that's the 150 basis point drop that I've mentioned.
Yeah.
But then when you look at the second half macros last year and this second half, they will be comparable.
You're right.
So if the macros are at the same level and you've picked up on the balance sheet, the volumes have picked up, then you should be able to see that picking up on the revenue side.
Okay.
Yeah.
On the operating environment, I'm sure there are certain ones that you constantly wake up in the morning, probably as I pull you out of your office, you are still checking how we're doing. What is intriguing you the most when you look at it? Because I think you've touched on central bank. We have seen quite a relative movement, not much of a movement there. But definitely there are other factors that you're looking at. Do you have a peek on what you're keenly checking on?
Yeah, I think for us, if you look at our revenue, 70% of our revenue is tied to the balance sheet.
Yeah.
And if you're tied to the balance sheet, then you're talking about the interest rate environment.
Oh, yeah.
Now, there are quite a number of metrics that affect interest rate.
Right.
At the moment, whatever is happening in Middle East has an impact on inflation. We've seen the price of the crude oil change. At times I always say, you could go to bed at a certain level, you wake up in the morning and everything has changed.
Something has changed,
depending, of course, on what is going there.
Yeah.
And so if inflation picks up, then it means automatically the interest rates will start picking up.
Yeah.
And so that's what we continuously monitor. If we look at the CBR, the central bank rate, which has been our benchmark rate for lending, we've seen consistent drop.
Okay.
We saw 10 consecutive drops all the way to by about 425 basis points. But right now, we've seen it's flattened.
Okay.
So it's at 8.75.
Okay.
But depending on what is happening in the Middle East, that can change. But the pressure on the inflation, although still within the CBK range of 2.5 to 7.5, that if it goes outside that window, then you start seeing rates picking up. Yeah?
Yeah.
And this one I'm talking about the benchmark rate.
Yeah.
But now if you look at T-bills, we start seeing T-bills picking up as well.
Yeah.
And so that starts putting pressure on the balance sheet.
Okay.
So it's one thing that we really focus. Today we have an asset liability committee. And the whole discussion, a big chunk of that discussion really looks at that because the impact on the balance sheet is quite significant. So that's a metric that we constantly look at. But there are factors which are beyond our control.
Yeah.
like now, whatever is happening in the Middle East, there's very little you can do about it.
Yeah, you can't control that.
Yes.
You're right. You know, when we spoke with you about 6 months ago, and I want to quote you, during the full year results of the previous year, you told me that you're working towards a 65-35 revenue mix between net interest income and unfunded income. And I've heard you mention a little bit of what you saw. Now, today we're about 72-28, and you know, is that 65-35 still the ambition, and what made this transition a little bit lagging?
Yeah. So that is over the MTP, so over the 3-year period. That's what we are looking at.
Okay.
There are specific interventions we've put. All our focus right now, while we are putting balance sheet in, the areas that we are really looking at is the non-funded income lines. And so the new businesses that I've mentioned, it's not by surprise that we've put a lot of focus in them. And this is the 3rd year we are seeing 20% growth rates in all of these businesses. So you could say maybe some of them, like custody business, was at an infancy level. But there are some which are now, we are seeing maturity, like our bank assurance business, but still delivering the 20% growth that we've mentioned. So we will continue with a lot of focus on that area. We are doing a lot of investments on the digital front. Later on in this second half, we'll be launching our digital standalone proposition. And all of these are putting emphasis now to start driving the non-funded income lines. So over the period, it will take time. Never forget, Maina, that the balance sheet is still growing.
It's still growing.
You know, for you to get to that 65-35 mix, you would assume maybe the one component of it is remaining stagnant. But that is still picking up.
We're still moving on.
And that's why we are saying we look at it over a 3-year period.
So loan yields have fallen. That's what I also noticed in the number, 14.1 to 12.16 when I was penciling through the numbers. And you're passing the benefits of lower interest rates to customers, which is really commendable. So how are you balancing from supporting borrowers through lower pricing while protecting shareholder returns? Remember, it's a balance, and we also don't want to lose anything at the end. No, a very good question. So there's one component of it, which is the lending. For you to then be able to protect the margins, then it means you have to look at the side of funding. So if you look at our deposit mix, that's one I mentioned. Last year, it was about 68% transactional. And then, of course, started to be in, your TDs. Right now, we've extended that. So now 75% of our deposit is transactional. Effectively, it means then our cost of funds have come down. So our cost of funds now has come down to about 2.8. So we've dropped it by about 100 basis points. Over this period, and that is just to contain the, the drop in on the lending side. Of course, then the balance there would be you've dropped on lending by 150 basis points, but then on the cost of funds you've dropped by about 100 basis points. You're right.
We've not been able to mitigate that fully. So that continues to be a focus area for us as we go into the second half.
Commendable work as well on the NPLs. And I just wanted to ask what's the magic behind it, because I see the numbers are going down, way lower, looking at the average in the industry. What's the work going there?
I think for us, the principles, whenever we look at NPL, I think for us, the principles that we put in the risk management, our risk management policies. We look at the sectors, we look at the exposure they are having. We look at the principles of, lending, for example, not having wrong risks, where you're lending in foreign currency, whereas, the customer, cash flows are in local currency. And so if you look at that, including the product mix, where you do diversification between unsecured and secured, then through that process, then of course, you can be able to see improvement in your NPL. But then on the back of that, of course, then is the interventions you're having. If customers are struggling, you speak to them upfront. We know about El Nino, for example. If I was to pick that, that example. El Nino is coming. We know sectors that will be exposed, especially agri. The discussions with our agri customers have been going on throughout. At this period. We know the ones who will be impacted, the ones who, or is your consumer book. because then the issue of affordability comes up.
Yeah.
So look at it 2 years ago. The T-bills were at around 16%.
Yeah.
So you can imagine on lending to the retail customer becomes a challenge.
Absolutely.
And so we saw that book coming down. The opposite happens. When rates come down, all of a sudden it's affordable, disposable income for the retail customers improves, and so that picks up.
Yeah.
The SME, which is the BB side, that then takes time.
Yeah.
Because with the customer, these are people who are trading. And like on the corporate, they have some flexibility. The SME can be impacted.
Yeah.
And so it takes time for them to be able to adjust their borrowing depending on where the rates are at a particular point in time. Yeah. So rates have started coming down, so they are catching up. We are seeing now that book also picking up, but not as immediate as what we've seen with the consumer book.
I want to close on some of your strategic focuses. I noticed an exit in the insurance manufacturing in Kenya and the likes. What's happening there?
I think, again, we look at strategy.
Yeah.
From a group perspective, the desire from a strategic point of view is we want to move away from manufacturing, which is insurance companies, to distribution. Distribution is our bank assurance business. So the distribution has done very well. It's less risky. It's part of our core. It allows us to then look at partnering with many insurance companies. Today, if you come to the bank, you take, for example, unsecured lending. We are mandated through the IRA to make sure that we open up and give you an opportunity for you to make a decision on which insurance company you want to take your cover to. And so it could be our sister companies that we've been having, or it could be any other insurance company, and we always open it up. However, on the distribution, which is our bank assurance, we get that commission. So from a group perspective, it's a decision that was made, exit manufacturing. We've already exited from 3 countries. So Mozambique, Botswana, and Zambia. And so Kenya was in line. So it's actually a plan that was already there.
I see that.
But something to also clarify there, the insurance companies are owned at Absa Group. So not in Absa Bank Kenya.
Lovely. I think I must ask one more question, because you are neighbors to a country that has attracted a lot of interest as well from some of the locals here, Ethiopia. Are you having some eyes there? I'm sure being a neighbor, you must be the one who's checking a lot of that.
Yes, no, definitely, Maina. There's interest in Ethiopia. Again, from a strategic point of view, the diversification pillar, we are looking at new markets. And Ethiopia is quite attractive, and Group has made it very clear that we are evaluating the opportunities there. So watch this space.
I love that. I'll be meeting you to talk about that further. Thank you so much for your time, Yusuf.
Thank you, Maina. Great being here.
Excellent. There you have it. That's Yusuf Omari, the interim CEO, Absa Kenya. Very optimistic that just wait and see. This is just one of the reports, but wait for the full year as well. Very optimistic about the numbers and what will be happening, as well as the strategic focus, and very bullish about the end of it all. Thank you so much for your time. I leave you now with the numbers.